Good morning, welcome to Ainsley News. Today, taper tempered and surprises surprise. Why more are turning to gold? That's right, it's Monday, the 6th of September. Friday night's US NFP employment numbers dished up a major miss with only 235,000 new jobs added in August, the weakest prints since January, against market expectations of 725,000 and a massive drop from July's 943,000. This next chart we're going to show you here illustrates this in context of the April 2020 plunge. It's that chart here for US job growth. And the chart we're going to show you next reminds us there are still over 5.3 million jobs short of the pre-pandemic employment numbers. Here's a chart here for context to show you those employment numbers all the way back to about 2010. The print saw many questioning whether the Fed would indeed maintain their QE taper talk, which saw the US dollar fall and gold surge on the result, up $25 to around US 18.30 per ounce. The stronger Aussie dollar off that USD took some of the shine off for Aussie gold holders, but it was still a very strong night. Interestingly, the usual bad news is good news trade on shares didn't really happen. As we discussed Friday, stimulus appears to be the main driver of financial markets, and tapering of that stimulus the major immediate threat. That this bad news was neutral to shares and gold surged may be a sign that more people are starting to understand the reality before them. It wasn't just the employment figures painting a concerning picture. We also saw poor market PMI prints in both manufacturing and services. The composite PMI, as shown in this next chart, is joining a rollover across the globe. Here's that chart here. That analysts are continually underestimating poor prints is showing through in the so-called economic surprise indices, where they are underestimating inflation and overestimating PMIs. In other words, the weaker than expected economy and stronger than expected inflation equaling the dreaded bogey, stagflation. Here's this other chart here showing potential stagflation. The aforementioned waning faith in everything is awesome narrative ultimately comes down to faith in the monetary policy and system. At some stage, the spectre of rampant money printing loses its effectiveness and then affects all that freshly printed, chronically debased currency, flooding the system, inevitably leads to the same result presented throughout history. Germans are arguably attuned to this more than most. Not surprising then, German demand for gold increased 35% in H1 of this year over the already strong previous half, according to the World Gold Council. The rest of the world saw an increase of a still robust 20%. Whilst the Fed hogged the central bank limelight, the ECB has on many levels been even more aggressive, and Germany has been in a negative interest rate environment now for several years, including negative yielding 2- and 5-year government bonds, consistently since 2015, and billions in quantitative easing. This from the World Gold Council. German investors have an acute awareness of wealth eroding effects of financial instability. Hyperinflation in the 1920s lingers on in the collective memory, but perhaps more importantly, German investors have seen fiat currencies come and go. In the past 100 years, Germany has had 8 different currencies. And it should come as no surprise that when faced with an unsettling economic backdrop, German investors turn to gold, which during our field research, one investor described as an enduring currency to protect their wealth. The US, as the world's reserve currency, may still be in denial that its hegemonic status could ever be challenged, but history tells us otherwise. Jim Ricard's recently shone a light on this. This from him. The greatest paradox in foreign exchange markets today is the US dollar. US fiscal responsibility is in ruins. In the past 2 years, the US has authorized $11.5 trillion of new deficit spending and increased its base money supply by over $4 trillion. The US debt to GDP ratio now stands at 130%, comparable to Lebanon, Italy, and Greece, among the most prolific countries in the world. Meanwhile, US growth is rapidly slowing. The Atlanta Fed GDP Now forecasting tool showed and projected annualized growth slowing from 13% in April to 11% in May, 7.5% in June. The actual GDP growth figure for the second quarter of 2021 was 6.5%. Third quarter growth is now projected at 5.1%. As the economic surprise indices highlight, this is almost certainly going to be too high. Reality is coming. Some will be ready and some won't. Well, thanks for joining us for news today, everyone. Hope you enjoyed it. Hope you gave you some insight there on the world markets. Remember, jump over to ainsleyBullion.com.au for all things physical, gold, silver, and platinum. Jump over to anzwealth.com.au for all things cryptocurrency. And check out Bitcoin, continues to flutter above 50,000 US dollars per Bitcoin. And goldsilverstandard.com, the ultimate stablecoin. Go and check out that. Our own crypto built and backed by real gold and real silver. Enjoy your Monday, everyone, and we'll catch you tomorrow for more news.